are equally as stunning. 10 years ago, activist hedge funds had less than $12 billion under management. Today, it's more than $120 billion, with more than 10 funds now managing more than $10 billion each. Why? Some cite the ongoing bull market, the raging rally of stocks since post-crisis 2008 as the catalyst. Companies were flush with cash and could borrow it at record low interest rates, and shareholders were hungry for a bigger piece of that pie. Enter the shareholder activists to get it for them, typically using a familiar playbook, usually a spin-off, share buyback, or cost-cutting initiative, always in the name of unlocking more value for all shareholders. There is also a case to be made that activism as a technique has become popular because in many cases it has worked. Big investors with big ideas and big names driving share prices higher, while forcing CEOs to maximize returns for their shareholders or else. The activist aggregator 13D Monitor found that between 2006 and 2011, the average one-day bump for a stock once an activist had revealed their position was 2.65%, with the average return over 15 months reaching 15.24%, dramatically outperforming the payout of the S&P 500 over the same time frame. But do these gains come at a cost? Leo E. Strine, the influential Chief Justice for the Delaware Supreme Court, wrote about activist hedge funds in February 2017's Yale Law Journal in his 133-page paper titled "Who Bleeds When the Wolves Bite?" A flesh and blood perspective on hedge fund activism and our strange corporate governance system. There is less reason to think activists are making the economy much more efficient and more reason to be concerned that they are perhaps pushing steady societal wealth on a riskier course that has no substantial long-term upside, he suggested. Distinguishing between so-called human investors, those of us who save for college or retirement, and the quote-unquote wolf packs of activist hedge funds who attempt to instill change in a corporation, Strine argued. What is commonly accepted about activist hedge funds is that they do not originally invest in companies they like and only become active when they become dissatisfied with the corporation's management or business plan. Rather, activists identify companies and take an equity position in them only when they have identified a way to change the corporation's operations in a manner that the hedge fund believes will cause its stock price to rise. The rise that most hedge funds seek must occur within a relatively short time period, because many activist hedge funds have historically retained their position for only 1 to 2 years at most. Judge Strine is not alone in his criticism of the perceived short-term nature of activists. Jeffrey A. Sonnenfeld, Senior Associate Dean of Leadership Studies at the Yale School of Management, argues that, quote, too often activists pressure companies to cut costs, add debt, sell divisions, and increase share repurchases, rather than invest in jobs, research and development, and growth, and that any value created by activists is, quote, often short-lived and sometimes comes at the expense of long-term success, if not survival. Others lament the activist class's herd mentality, too much money chasing too few good ideas. Lawrence D. Fink, the noted and outspoken CEO of the world's largest asset manager, BlackRock, decries the quick-fix approach as damaging to the corporate structure at large. In February 2016, in a letter sent to hundreds of chief executives, he urged them to focus on, quote, long-term value creation, rather than on buybacks and other initiatives. The famed corporate lawyer Martin Lipton, known as the creator of the poison pill defense tool, designed to protect a company from a hostile takeover, would declare that hedge fund activists are ruining America rather than helping it. But even Mr. Lipton would certainly attest that there's no denying the rock star status these activist investors have achieved, mostly for their methods, but sometimes as much for their madness, their noise, and provided platforms. Never was that more apparent than in the years-long public battle over Herbalife, which began